Hey folks, Dave McKnight here, best-selling author of The Power of Zero. Today we're going to talk about what happened when NASCAR legend Kyle Busch reportedly lost over $8 million in what was supposed to be a tax-free retirement plan built around an index universal life insurance policy and what we can learn from it. Okay, let's dig into the lawsuit. Kyle Busch and his wife Samantha say they paid more than $10.4 million into several IUL policies issued by Pac Life between 2018 and 2022. These policies were pitched as a safe, self-funding, tax-free retirement plan. But according to their lawsuit, things didn't go as promised. They claim their policies were supposed to switch from an increasing death benefit to a level death benefit after year one, but that change never happened. That meant the net amount at risk, or the amount of actual life insurance they were required to pay for, stayed high, and so did the policy's fees and expenses. They were told certain premium payments would be final, that the policies would be fully funded. But a few years later, they got a surprise notice demanding more premium to prevent the policies from lapsing. They also performed a 1035 exchange 4 years into the contract, a transfer of cash value from one policy to another, which triggered new upfront costs, new commissions, and new surrender schedules, dealing another blow to their already depleted cash value. Over time, the high insurance charges and underperforming index crediting eroded the cash value, leaving the Bushes with an estimated loss of over $8 million. There were no premium finance loans involved in this transaction, as has been rumored. Just compounding structural problems that drained the cash value year after year until the policies became unsustainable. So what really caused this disaster? First, poor design. IULs are flexible by nature. It's their strength, but it can also be their Achilles heel. The Bushes' policies were apparently set to switch from option B to option A once the funding period was over. Option B allows you to put more money into the contract in the early years when expenses are lower, and then switch to option A to keep those expenses lower over time. But if you forget to switch to option A at the right time, those internal charges can end up cannibalizing your cash value, and that is apparently what happened in this case. Second, unrealistic expectations. The Bushes were allegedly told the policies would fund themselves after a few years, that they could stop paying premiums and still watch the cash value grow. That might happen in an ideal scenario where a policy gets structured properly. And by structured properly, I mean buying as little insurance as the IRS requires of you and stuffing as much money into it as the IRS allows. That means that your expenses as a percentage of your overall cash value remain as low as legally possible. But that is clearly not what happened in this particular case. Third, a delayed 1035 exchange. Apparently, the Bushes started this policy in 2018, but did a 1035 exchange in 2022. Now, normally when you do a 1035 exchange, which is a tax-free transfer of cash value from an older policy into a newer policy, that happens at policy inception. But for some reason, the Bushes were persuaded to do a 1035 exchange 4 years into the policy in 2022, which was the financial equivalent of hitting the reset button. It generated new upfront charges, new surrender schedules, and new commissions. It's sort of like climbing halfway up a mountain and starting all over again with a heavier backpack. If you're going to do a 1035 exchange, make sure you do it at the start of the policy, not years into it. And finally, poor oversight. The complaint alleges that some compliance steps were skipped and that key documents weren't delivered. Whether that's true or not will be sorted out in court, but a larger lesson remains. You can't set it and forget it with complex permanent life insurance. These contracts must be managed and assessed annually. How is it performing? Is it living up to illustrated rates? Do tweaks need to be made to the policy structure to ensure it continues to perform at optimal levels? Lessons learned. Okay, so what are the lessons we can take from this Kyle Busch lawsuit against Pacific Life? Lesson 1, never enter into a contract that you don't understand. If the agent says, don't worry, it'll fund itself, run the other direction. The truth is that IULs can perform very productively, but only if they're structured and maintained properly. Lesson 2. Don't do an IUL if you can't overfund it day one. The sweet spot for IUL is when you buy as little death benefit as the IRS requires of you and you stuff as much money into it as the IRS allows. That keeps your internal costs low and maximizes your tax-free growth potential under IRS guidelines. Don't start an IUL if you don't have the ability or willingness to do this from day one. Lesson 3. Do a 1035 exchange at policy inception. When you do a 1035 exchange years into a policy, it could require an increase in death benefit to accommodate that extra premium, and that could cause you to restart your surrender period and trigger new loads and commissions. If your existing IUL is well funded and performing reasonably, think long and hard before resetting the clock. Lesson 4. Don't rely on the IUL alone. The Busch case is a cautionary tale about what happens when one strategy is positioned as a silver bullet retirement solution. In reality, IULs are just one arrow in your quiver. The IUL only really works when used in concert with a number of other streams of tax-free income available in the U.S. tax code. I'm talking about Roth IRAs, Roth 401ks, Roth conversions from traditional IRAs, tax-free distributions from IRAs and 401ks up to your standard deduction, and tax-free Social Security if you can keep your provisional income low enough. In this type of balanced, comprehensive approach to tax-free retirement, the IUL's purpose is not to carry the whole load, but to act as a shock absorber, smoothing your retirement cash flow when markets fall. Its best possible use, in my opinion, is as a volatility buffer in retirement. This was the IUL application highlighted in the recent Ernst & Young study that demonstrated that a retirement income strategy that incorporates IUL provides far more income than a strategy that calls for investments alone. Here's how it works. Build between 3 and 5 years worth of living expenses in your IUL by day one of retirement, and then in the year following a down year in your Roth IRA or Roth 401k, pay for your living expenses out of your IUL. That will give your stock portfolio a chance to recover before you take further distributions. This act alone can increase the sustainable withdrawal rate on your stock portfolio from 4% to as high as 8% with a 95% likelihood your money will last through your actuarial life expectancy. Lesson 5. Monitor and adjust. Every year, your advisor should be reviewing your IUL with you to ensure that the crediting rate is tracking within expectations, the cost of insurance is still manageable, the policy's cash value is going in the right direction, and the death benefit option is correct. So here are a few tips on how to avoid the IUL trap that the Bushes unfortunately fell into. Work with a fiduciary-minded advisor who understands both tax law and policy mechanics, not just the sales illustration. Designed for long-term accumulation, not short-term payoff. The policy should be overfunded early and allowed to simmer for 10 to 15 years before you start taking tax-free loans. Stress test the illustration. Ask, what if the cap rate drops by 2 points? What if the cost of insurance rises faster than expected? What happens to my cash value? Avoid illustration gimmicks. Things like multipliers and exotic indexing options look flashy, but often come with higher internal costs and no track records. Simpler is better when it comes to IUL policy growth and structure. Coordinate it with your other tax-free assets. The IUL should always be a complement to your other tax-free accounts, not a replacement for. When structured and monitored properly, the IUL can give you a floor of 0% that protects against market losses, tax-free access to your cash value through policy loans, the ability to receive your death benefit in advance of your death for the purpose of paying for long-term care. So yes, the Kyle Busch case is a cautionary tale, but it doesn't mean IULs are inherently bad or scams. But it does mean they can cause damage if sold by scammy advisors who aren't looking out for the best interest of their clients. When you understand how IULs work, when you overfund them, monitor them, and integrate them into a balanced, comprehensive approach to tax-free retirement, they can deliver exactly what they promise. Safe, predictable, tax-free retirement income that can help you wring the most efficiency out of all your other tax-free streams of income. Remember, the goal is not to have one perfect product, but multiple streams of tax-free income that complement each other. The IUL is just one piece of the tax-free retirement planning puzzle that's designed to make your entire retirement strategy run much more smoothly. If you're thinking about incorporating an IUL into a balanced, comprehensive approach to tax-free retirement, head over to DaveMcKnight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in my network who has been trained, vetted, and qualified personally by me. I'm David McKnight. Thanks for watching, and don't forget to like, subscribe, and share this video with anyone who's ever wondered whether IULs still make sense in a tax-free retirement plan. Spoiler alert, they do, but only if structured properly.